two lenders offer you the exact same 7% interest rate, one of them is going to cost you $6,000 more. Nothing about that 7% tells you which one. So here is the answer. Straight. The interest rate is what it costs to borrow the money. The APR is what it costs to borrow the money, plus the fees the lender charges you to hand it over. That is the whole difference. One number is the price of the loan. The other is the price of the loan and the paperwork attached to it, which is why the APR is almost always the higher of the two, and why lenders love to advertise the other one. But that raises a much more uncomfortable question. If the APR is the honest number, why does every single advertisement you have ever seen lead with the interest rate instead? Why is the smaller number the one on the billboard? And here is the part that should genuinely bother you. The APR is the better number, it is required by federal law, and it still does not tell you the truth about your loan. Not because lenders are hiding something in it, but because of an assumption baked into how APR is calculated, an assumption that is wrong for most people who take out a mortgage. I will show you exactly what that assumption is, because it is the single most useful thing here, and almost nobody explains it. First, let's be specific about what those fees actually are, because fees is doing a lot of quiet work in that sentence. When you take out a mortgage, the APR folds in the origination fee, which is what the lender charges just for creating your loan, document preparation, processing your application, underwriting. It also folds in mortgage broker fees. It folds in discount points, which is money you pay upfront specifically to buy your interest rate down. And it folds in most of your closing costs and your mortgage insurance. Now here is the number that reframes all of this. Closing costs on a mortgage typically run between 2 and 6% of the loan amount. On a $300,000 loan, that is somewhere between $6,000 and $18,000. That is not a rounding error. That is a used car sitting inside your loan, and the interest rate says nothing about it. So let's put real numbers on it. You are borrowing $300,000 on a 30-year fixed mortgage at 7%. The lender charges a 1% origination fee, which is $3,000. You also buy one discount point, which is another $3,000, $6,000 in fees total. Your interest rate is still 7%. Nothing changed about that. But your APR is now 7.197%. Look at how small that looks written down. 7% versus 7.2. It reads like a rounding difference. It is $6,000. That is the trick this number plays on your brain, and it works because our eyes are terrible at converting decimals into money. Two loans can advertise the identical 7% and be $6,000 apart. And the only place that gap shows up is the number nobody puts on the billboard. Which brings us to why APR exists at all, and it is not because lenders volunteered it. Before 1968, a lender could advertise whatever rate sounded best and bury the actual cost of the loan in fees you would not see until closing day. There was no requirement to show you one combined number. So Congress passed the Truth in Lending Act, and it forced every lender to disclose the APR right next to the interest rate before you finalize the loan. Today it shows up in two specific places: your loan estimate and your closing disclosure. That is a legal requirement, not a courtesy. Think about what that tells you. The government had to write a law to make this number appear, which means for decades, the entire industry was perfectly comfortable letting you compare loans using a number that left the fees out. Now, there is one place where this whole distinction quietly collapses, and it is the place most people encounter the word APR first. Your credit card. On a credit card, the APR and the interest rate are effectively the same number. There is no origination fee rolled in, no points, no closing costs, so there is nothing for the APR to absorb, which means on a card, the APR is not the number that decides what you pay. The grace period is. Most cards give you somewhere between 21 and 25 days after your billing cycle closes, and if you pay your statement balance in full inside that window, you are charged no interest at all. Your card can have a 29% APR and you can pay 0. That is worth sitting with. But miss it and the rules flip hard. You get charged interest on the unpaid balance and on every new purchase from the moment you make it. And cash advances usually have no grace period at all. Interest starts the day you take the money. And while we are on cards, there is something else worth knowing, because people talk about my card's APR like it is one number. It usually is not. A single credit card can carry 4 or 5 different APRs at the same time, and they apply to different things you do with it. There is the purchase APR, which is the one you see advertised. There is a separate balance transfer APR, often lower, often promotional. There is a cash advance APR, which is usually higher and, as we covered, has no grace period. There might be an introductory APR, sometimes 0%, that runs 6 to 18 months and then expires into the regular rate. And then there is the one that actually catches people, the penalty APR. Miss your payments by more than 60 days and your card can move you onto a significantly higher rate, and it can keep you there for at least 6 months. Same card, same account, a completely different cost of borrowing triggered by a date. One more thing worth checking. Most cards are variable rate, tied to the prime rate set by the Federal Reserve, which means the number you agreed to is not the number you will always have. So back to that promise I made you, the assumption baked into APR. Here it is. APR assumes you keep the loan for its entire term, on a mortgage that is 30 years. Now ask yourself how many people actually keep a mortgage for 30 years. They sell, they refinance, they come into money and pay it off early. Most mortgages do not survive anywhere near their full term. And this matters enormously, because APR takes your upfront fees and spreads them thinly across all 30 years to calculate that percentage. Spread $6,000 over 30 years and it barely moves the number. But if you sell that house in 7 years, those exact same $6,000 got absorbed over 7 years instead of 30, and they hurt several times more than your APR suggested they would. The APR did not lie to you. It answered a question you never asked. So what do you do with that? It gives you a rule that is genuinely useful the next time you are holding 2 loan offers. When 2 loans show you the same APR, take the one with the lower upfront fees, as long as there is any chance you move, refinance, or pay it off early. Same APR, less money handed over on day 1, and you keep the flexibility. And if you are specifically weighing a refinance, do the break-even math instead of trusting the percentage. If refinancing costs you $6,000 and saves you $300 a month, you break even in 20 months. A common rule of thumb from mortgage brokers is that refinancing tends to only be worth it if that break-even lands around 2 years or less. That is a calculation you can do on your phone in about 15 seconds, and it answers the question APR structurally cannot. So, bringing it home, the interest rate is the cost of the money. The APR is the cost of the money plus the lender's fees, which is why it is higher and why it exists in federal law at all. On a credit card, ignore the distinction and protect your grace period instead. And on any loan with real upfront fees, remember that APR quietly assumes you will still be paying that loan in 30 years, which most people will not. Compare the APR, then look straight at the fees underneath it. That is the move. Tell me in the comments whether the last loan you signed showed you an APR you actually noticed, because I suspect a lot of us signed without ever looking at it.